A common and costly mistake is paying taxes twice on your Walmart restricted stock units. In this video, we'll review how to avoid double taxation on your Walmart RSUs, as well as how to check if you were double taxed on a previous year's tax return. Restricted stock is taxed on the vesting date, and the taxable income is calculated by the number of shares that vest multiplied by the share price. This taxable income is reported in Box 1 of your W-2 form, along with any other taxable income from your base salary and MIP. The income that is taxed now becomes the cost basis of your Walmart shares. For example, if one share vests at $60, that generates $60 of taxable income. This taxable income is reported on your W-2 form and should not be taxed again. So far, so good, but the issue arises when you sell these Walmart shares. The 1099-B form that the firm who holds your accounts sends you at the beginning of the year for your taxes often reports this cost basis at $0. You can see here that the participant sold $20,813 worth of Walmart stock, but the form shows that the cost basis is $0 and that the taxable realized gain is the full $20,813. Of course, the cost basis is not actually $0 because the participant already paid taxes on the amount that vested. To report the correct cost basis on your tax return and not be double taxed, you may need to make a cost basis adjustment. So where do you find that information? The supplemental information provided along with the 1099-B form provides the correct cost basis to be reported on the tax return. In this case, the actual cost basis is $20,684. The participant pays tax only on the price appreciation of $129. This is the taxable investment gain on the Walmart shares since they vested. Now, how do you check to make sure you weren't double taxed on a previous year's tax return? One way is to review Form 8949 on a previous year's return. When you review it, you'll likely see a line for the Fidelity or the Merrill account that received and later sold these Walmart RSUs. If the cost basis is zero or very low and or there's no adjustment as there is on this return, you may consider doing a little research to see if it makes sense to file an amendment with the IRS or hire a tax professional to handle it for you. Of course, we never want to pay unnecessary taxes, and as your career progresses, more and more of your income will come from equity compensation, making these sorts of mistakes even more costly. If you have any questions, feel free to connect. I'm happy to try to help.